So you think machines can, in fact, handle the trading
Yes,
better than man?
what we do is, first, we define an investment goal, and that's discretionary. So we say, okay, we want to harvest long-only risk premium over different asset classes with futures. Or we say we want to follow momentum and carry in a long-short way over different asset classes with future. And in the next step, we define an investment process. We say, okay, we need universe where we want to invest in. We need signal. We harvest the information there. They come up with a signal, and we do a portfolio construction. And then in a third step, we say, okay, that we can do with computers. So we give them the algorithm, clear defined what they have to do, and they follow that. So what is the benefit for the investor is actually that it's very disciplined approach. We're not changing within the time.
Okay.
So the long-only program is not suddenly going short and doing some woofy things.
Okay.
And on the other hand, it's very predictable because, for instance, the long-only, you know, if market look attractive on momentum and carry and they are less risky, we have a big position on. If it's the opposite, it's vice versa.
But markets are unpredictable, or?
Oh, well, they are.
So, so if you put in an algorithm that's based on being predictable, but the markets are unpredictable, how do you?
No, the investment process, how it will react to market moves, is predictable. So now exactly like in the sell-off, if you have a sell-off, we will reduce the positions.
Okay. Okay. Well, actually, now that you mentioned the sell-off, I came across research notes by a fellow, well, not your fellow, but J.P. Morgan, that said that in June of 2017, looking back at the sell-offs in June 2017, in the 9th and 12th, the sell-off in technology stocks, that they were based. He attributed the sell-off to computer-based algorithms receiving sell signals. So then my question was, well, did this have an influence on the recent sell-off we just saw? Well,
one has to distinguish between the different algorithms. There are market-making algorithms that actually, when you place big orders, they slice and dice it and feed it through the market. That's a completely different area. And of course, if you have many participants selling their stocks, it goes through this algorithm, but the pressure on the stock comes from the institutionals or the retail clients that sell their stocks. So there I don't see a self-feeding effect in the market that continues to put pressure on the stocks. Especially it's more the other way around, that through this feeding over time, you have less this bump in the market that it suddenly goes down because somebody places a huge order. So things get more continuous and softer. On the other hand, you have different investment processes driven by quantitative methodologies. And there you have some that follow the same strategy. Many are harvesting the long-only risk premium. Some are contrarian. They say, okay, if the market goes down, we start to buy again. Others say, if the market goes down, we reduce the position. There's so much variety out there. I don't think the computers drive the market.
You don't think they drive the market?
Yep.
But computer-based trading dominates now the way we trade.
The algorithm to feed the order through the market, that dominate. But it has also to do with compliance reasons, because there you can more handle than traders that do whatever things.
Okay, so just so I'm clear, you don't think that the algorithms played a role in the recent sell-off?
No, I would say it's the other way around. If they would really dominate the market, they would make a lot of money. I would actually appreciate that. But I'm happy it's not that way.
But okay, all right. Why would you appreciate that?
Because then we could more or less choose in which direction the market goes. It would be very beneficial to the strategies.
Now, when it comes to AI and trading, then how does that, well, AI and trading, is this how you would describe what you do?
Well, artificial intelligence, we started looking into it a very long time ago. How does it differ from, let's say, more the old school algorithm? It's you have more parameters, you have more optimization steps, you have more feedback loops, and you have a larger data set available where you apply them, basically. So it's not different to what we did before, because you still have this investment process where you have certain steps that you can translate into an algorithm. And now you just have the possibility to go into different algorithms and get new features to the investment process. For instance, we found in artificial intelligence an algorithm that measured the momentum in a more adaptive way. So it was very beneficial if you have a system break where suddenly you go from long trend to short trend, and it changed faster. And that we put on in the investment process, and now it's beneficial to the investor. But I don't think that artificial intelligence will take over the whole investment process. It decides where and how to invest the money and what kind of strategy to follow without humans that clearly define and tell them what to do.
And learning machines, like these that really are into
learning
and repeating behavior.
Learning is that they on their own adapt the parameters.
Yeah.
But still, you feel comfortable when you know in the investment process what algorithm is doing than when you don't know what it's doing. So I don't think there is enough comfort level to invest money that way.
And in other words, investors, at the end of the day, traders, they're not all going to be without work. At the end of the day, you still need, is what you're saying.
No, I mean, actually, the experience we made is we are in this business now for a long time. Of course, we don't have 10 fundamental researchers and 10 portfolio managers running the strategies. But we do have IT specialists for the database. We do have research specialists more on algorithm, the other one more on optimization. So it's just creating different jobs, maintaining the investment process.
And maintaining the man behind the machine.
Yes.
So somehow, I also came across an article where the writer said that systematic funds employ armies of quants, as you say, right? That's what you call them, quantitative methodologists. Is that right?
Yeah.
Who are great at math and programming, but useless at trading.
I mean, that's a fair statement, but it goes more a little bit in a different direction. I mean, what we do is we define the investment goal.
Okay.
It's not that we do a day-on-day trading and we look in which direction goes the market and then do whatever things. And then we define the investment process. And that, I mean, these investment teams you have normally, you have to be very careful how you put them together. And you need different competencies. So you definitely need persons that are coming from economics, you need persons that are coming from math, from IT, and from physics. So the more heterogeneous,
You're a mathematician, right?
I'm actually
Partially.
a mathematician and a lawyer.
And a lawyer, correct.
Yeah.
All right.
So I don't need the law thing that much,
But it helps to
it's
be
helpful in daily business.
Yeah.
And then when it goes to define the investment goal, obviously there's a lot of economical reasoning behind that. They say, okay, it's meaningful to invest money in that way.
Right.
Then we clearly define the investment process. But then when it comes to how we measure the momentum, that's more a mathematical discipline. Then you say, okay, what is momentum for us? How do we define them? What type of momentum we want to measure? And so on. So it's this interaction between the different disciplines that actually makes it out.
And do you feel then that this system is in fact where we're going, where we're headed? There's no turning back at this point in terms of moving ahead with AI?
No, I mean, I think we are at the very beginning with AI. So it's definitely the stage where it's important to find out what is meaningful to do with it and what is more kind of a fairy tale.
There's plenty of fairy tale out there,
There's plenty
right?
of fairy tale. I can sometimes, I compare it with the industrialization like 110 years ago. The end of it, it created more jobs, but different jobs. And so that's basically what I expect here.
Different kinds of jobs. So you have to really train more. You have to really adapt the way that you train people, which of course is, part of the path for you. I mean, for your company and for people that are using systematic trading, right?
Definitely, yeah. I mean, somebody new comes in first. I mean, they bring all their abstract knowledge. They were taught at universities or schools or some courses, wherever. And then we have to kind of, for 1 or 2 years, to teach them how you can apply this in real life, because there is a gap in between. It's not directly applicable.
Right.
And that comes a lot with intuition and basically fundamental understanding of the markets.
Wonderful. So again, man plays a strong role.
At the end of the day, it's humans behind it, yes. That's my clear conviction.
Thank you, Urs, so much for your time and for your insights today on the living markets.
Thank you.